Hi, it's Marco here. So today, Fed Chair Jerome Powell has come out with incredible news that will affect the stock market crash and your portfolio. Let's dive straight into it. So the first bit of news that he came out with is the fact that they are going to increase interest rates, and that's the final confirmation that everyone, and emphasize everyone, was waiting for, and most importantly, has had an incredibly positive effect on the stock market. And also on this video we're going to look at what the future will hold for it. So let's have a look at, first of all, that bit of news that is incredibly important, because as you know, it just came out today and the market had a bit of a positive reaction to it, which is to be expected, I suppose, because it's not the 0.5% increase that Jerome Powell was hinting at in the past. It's just a 0.25% increase, and let's have a look at the bit of news just now. So that's the commentary, and finally, that's what basically Mr. Powell said. In an unusual clear commentary, the central bank top official added that he supports increasing short-term interest rates by 0.25% in the next policy setting meeting on March and the 16th. And that is not basically going to be the 0.50% that was basically predicted before. So the market overall has had a very positive reaction, at least today. But what the future is, basically the scenario that is in front of us, and it's panning out, it's totally as I've been predicting, as I've been telling you on this channel. So congratulations on all my subscribers who have been ahead of the curve. So your portfolios, my portfolio, basically everyone's portfolio is doing very well, because we know, and we've been telling you, that this increasing rates is bad news. I want to say the truth, it's just bad news for stock market investors. And also, if you are a crypto investor, I'm afraid it's bad news. Now, going forward, what Jerome Powell did not say is that there is going to be probably increases, but what he did not tell us is an end date of when we are going to actually stop having these increases. What he actually told us is that we're going to have this first increase, and then mostly we're going to have increases every time that there is a Fed meeting. Now, that is once again very negative, and later we're going to look at basically an estimate of where we are going from now. And we're going to look at the chart, the S&P 500, because in the past something similar happened in recent history as well, and it didn't look good. Sorry, I just wanted to be incredibly straight to the point, but at least it's something that we definitely have to have a look at later. So we are going to have this increase in interest rates, and the narrative is what basically follows. The money will move from stocks into bonds. That's it. And the reason is so easy that probably even a baby could actually explain that. Simply, bonds have been like left alone, ignored for years. And now they are becoming more interesting. And then what happens? Investors are then moving from stocks, and stocks used to be the only way to make money. Now they're moving to the more appealing bonds. And the more the Fed increases their interest rates, well, the more bonds become appealing. And so we have this inflation that Mr. Jerome Powell said basically he's lost control over it. That's literally the bottom line. If I have to summarize 5 minutes or more of him talking, just basically pretending that he didn't know about this mess. He pumped something like 40% of the supply of dollars into the market, probably even higher now, in just 1 or 2 years. Now, this incredible amount of money obviously would have to have some repercussions. So what he said was that the problem was the supply. The supply of goods did not come through. The supply wasn't strong enough to absorb 40% of the dollars. Guys, this is just think about it. Obviously, it's just him blaming the supply, but we know that the amount of money that he pumped into the system, and he's still pumping, that's something we have to have a look at later as well. All this money is obviously the reason behind inflation, and he's finally coming to senses, not because of himself, not because he's got finally he's finally woken up from his slumber. It's because Joe Biden is now finally doing something, at least, or putting pressure on him, and Mr. Fed Powell is saying, well, yeah, you're the boss, so now I'm gonna do as you tell me to. So, as I told you, increasing these interest rates, let's have a look at what is going to happen in the future, and that's what we're gonna open now based on the past, because as you know, past performance do not necessarily predict future returns. But if you look at the past, we see that we have had this basically drop, mostly that's the S&P 500, by the way, guys. We had this drop mostly as a result, and especially in the last 2 weeks, mostly as a result of the war, which we've been talking about on this channel. But this pattern is not something that is completely brand new. It's something that we have seen in the past as well. And I've been predicting, and I was like, poof, and I was like, this is no news for me. It's just like what happened back in, guess what, 2018. So we see this pattern, and it was for a number of reasons. We had this first crash, and that was due to the Fed basically deciding to sell their bonds, so offload their balance sheet, which we're gonna talk about later in the video. But the reason for this initial crash, was the Fed not supporting the bond market, and by extension, even not supporting the stock market. Why is this relevant to us? Well, in our case, people obviously learn from the past. As we learn on this channel about the stock market, there are people who actually just spend their days just looking at charts and make decisions on vast amounts of money. So what happened here is that basically when the Fed pulled the plug on the bonds, they had the first crash, and then we entered this cycle of basically trading. This is just what happens when big institutions trade in and out of the market and screw, and yes, I said screw, small investors like you and me. So it's not a good time to invest. So that's what happened back then, and then the final crash was basically the Fed keep on increasing the interest rates, because up until here they've been increasing over and over and over, until a certain point there were so many increases that the market completely gave out, and it bottomed out over here. Then the Fed, what basically they decreed and was the reason for the bottom, was when the Fed finally said, guys, we are gonna now support the market again by increasing our balance sheet, which means easy money, which also means buying bonds. So fast forward to today, which I'm gonna just go very quickly by pressing this button, and now I need to scroll up. But basically what happened over here is an anticipation of the offload of money that will happen when the Fed will basically start offloading their balance sheet and start selling bonds. And what we see here is a reaction also to interest rates. And so what is incredibly important from an investor point of view, from my point of view, for your point of view, is first of all to subscribe to this channel, because we look at this important news in much detail. and also to know that these interest rates increases for the 10-year yield, basically for the basically the Fed interest rate, is incredibly bad news. We today saw a bit of a hooray, a bit of a market positive reaction to it, but it's just the moment. When we're gonna get closer to the date, when we're gonna actually see the increase, I swear to God, it won't be pretty. And the day, we will see the date, like when they increase it, and that will be incredibly bad. On top of that, when they're gonna start offloading the balance sheet, that will be incredibly bad. So we have so much poop, let's call it lots of shit we have to go through before we get to the end of this tunnel. And this tunnel is paved with our own tears. So please be extra careful. So if from an investing point of view, the best thing to do, the safest thing to do, would be to wait for the Fed to flip for real, which means to basically move from their hawkish position, which is what they are taking now. So no more higher interest rates, and no more like deciding to offload their balance sheet. From when they move from there to actually supporting the stock market. So when they will start saying, okay, we're now going to reduce interest rates and we're going to pump money into the market by increasing our balance sheet. So that's the very safe play to do. Now, the only way to stay up to date with this type of news is to subscribe to this channel, because we look at this every time that we get news on the Fed, so you're always up to date. But also, if, for example, you do want to still make money and take a bit of a gamble, the other thing you can do is passive investing, which is something that is very simple. You would buy like an ETF on a regular basis, and that would be whether the market is going down or going up. And the idea is to stay invested in the market for a long time. So that would be 5, 10, 20, 30 years. So that's a very simple way of making money. Now, on this channel, we look at also single stocks, and that's something that you would mostly look for and invest in when the market is favorable. And that's why we have so much focus on the Fed and their monetary policy. So other than that, we're gonna make more videos. Thank you for watching, and I'll see you next time.